Okay guys, just continuing on with the little videos for foundation trading. What I'm trying to do this week is literally put the foundation in the introduction. I know everybody just thinks, just show me the strategy, show me where to get in, where to get out. Well, you failed before you start, because like any other job, you need to understand what it is you're doing and why you're doing it. You can't just go, I get in here and I get out there. That's actually the tip of the iceberg when it comes to trading. You need to concentrate on your psychology. You need to concentrate on the markets you're going to trade, how many markets you're going to trade, and what time you're going to trade. All of these factors come into it. And then you need to start working out what conditions happen at different times of the day. You know, you've got the Asian session, which is very quiet, it's very flat. You've got the London session, which is quite buoyant. You know, markets will move around quite a lot. Then you've got the New York session, which the beginning part is quite buoyant, but the latter part is quite flat. So again, it's recognizing conditions, but it's also platforms and whether or not you're a share trader, Forex trader, indices trader. And why does the platform affect them? Well, if you're a spread better, you don't pay commissions, you just pay the spread, and it's quite tax efficient. If you're a CFD trader, you're buying a contract and the spread, and it makes a difference from product to product because some are more expensive than others. And then if you're a share or traditional Forex trader, not only are you paying the spread, you're paying the commission. So the time of the day and the markets do affect what you do. So these are things that you need to think about before you even click a mouse. So what I'm going to do is I'm going to quickly show you how to work out a risk very quickly. Now, risk is one of the things that you need to pay attention to probably more than anything else, because as your job, it's not to make money, it's to preserve money. Because if your account is gone, you cannot trade. So the first thing you need to consider is how to preserve that account, and that's where money management and risk management come into it. Now I've just quickly knocked up a spreadsheet to show you. Now this is the compound spreadsheet. You'll see various versions of this when I'm trading. When I do challenges, I just kind of use this sheet. I do have a bigger version which goes month to month to month. But the part I want to draw attention to is this section here. Okay, now this is how you work your risk out. So no matter what you start with, say you are on a what's deemed a nano account, 1,000 below, right, I'll tell you the differences there as well. Below £1,000 is classed as a nano account. It's a micro account. Okay, if you're under 10,000, so 1,000 to 10,000, it's classed as a small account. 10,000 up to 50,000 is a medium account. 50,000 into a six-figure account is a large account. All right, and you'll find as you go up the ladder, your risk tolerance will change dramatically, because when you're dealing with £1,000 in this instance, you might think to yourself, well, I'm only going to trade, I'm going to risk 5%. So you're risking 5%, and the calculation is this. So it's 5% of your balance, okay? So that's £50. Then to find out your position size, you need to know where you're going to place your stop. Now, stops are a subject on their own. Some people like tight stops, others like wide stops, and then you've got the bits in the middle. Personally, I'm a wide stop person, but I also manage the trade, and very rarely my stop is hit because I'll kill the trade before it gets there. I have psychological mental points where I evaluate what's going on, and if I think I'm wrong, I'll just kill it. I'll just cut my losses and that's it, unless I think I can manage out of it. Okay, so you need to be aware of that. The standard industry is 1 to 2% of the account. I don't necessarily go with that. I go with money. So in this instance, you're looking at £50, which equates to 5%. If you've looked at the chart and you think your stop loss can be safely hidden, it's 20 to 30 pips away. That's what you would put in here. So this could be anything. You could even say it is 40 pips, and then it gives you a position size. Okay, and then what you need to do is you then need to figure out what your profit ratios are, whether you're sort of going to be an inverse profit. In other words, you might be risking 40 but getting 20 pips, but you have a mental stop loss at 20, so effectively it becomes 1 to 1. If you're going sort of 2 to 1, things like that, that's where you need to consider your profit. But this is all based on risk, and the way it works is it is just literally that divide by the stop loss gives you your position size. That's simple. That's the easiest way to work it out. All right, so that's just a snapshot of what your risk tolerance is. Now let's just say you're on a large account and you have 25,000 in there. Now it's the same trade at 5% of your account, but instead of your £50, you're risking 1,250. Now you might consider that too much to bear, and this is why the percentage against account changes. When you've got a small account, your risk can be quite big, because in reality it's not hurting you that much. But as your account grows, your risk tolerance should come down. Personally, I'm anywhere between 2 to 4% of my account, and that's kind of the way it works. But I've got a high win rate, I'm very confident in what I do, and I'll push the boat out. I'm quite happy to run 2 trades running at 4% each, but I know I can get out of it. If it goes wrong, well, it's just a bad day at the office. But let's see what the dynamics change. If I change that 2%, suddenly that becomes 500. It's a lot more palatable. But if you get into large accounts, I'll give you an idea, say 80,000, and you're at 2%, that's 1,600. And your position size can be 40 in this instance. But what you would do, you could say have a larger stop loss. Your risk is 1,600, which is 2%. You've got a wide berth to play with, and it gives you a position size of around £20. Okay, and I hope that helps. But that's roughly how you work out a risk. Okay, for those in the Discord, I'll post this sheet on there, and you're very welcome to use it. Okay, have yourselves a good one, guys, and I'll catch you soon. But always keep your questions coming, and I'll drop them into little videos to build the library up for you, and we'll get along this journey together. So keep well, catch you soon.